Today I have with me Chirag Setalvad of HDFC AMC. First, from your vantage point, where are we at in the market right now? And would you be slightly cautious at this level?
I think I would be more than slightly cautious. I think markets have rallied very, very sharply. I mean, who would have thought all of these events would have happened and the market would be an all-time high?
Do you foresee any major price correction in this market?
That's a trillion-dollar question. So I don't have an answer to that.
So how does one approach this market from a portfolio standpoint? If you're a bit cautious, is it better to raise cash level?
So we don't move into cash to a significant extent. Our cash levels vary from 0 to 10. So at 0, we are incredibly bullish. At 10, we are incredibly bearish. We are currently 6-7%, which reflects that we are cautious at this point of time. I have a lot of patience. I think 4, 5, 6 quarters is nothing. That's, we are seeing quarters. We're talking in years. The minute you say 10 years, people roll their eyes. Why are people rolling their eyes at 10-year holdings? Every investor who's made serious money has held for the long term.
So if you look at the HDFC small cap fund performance, it has underperformed the benchmark. So what would your argument be to that?
So actually
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world.
Hey guys, welcome to the Money Mindset. Thank you so much for watching our show and for all the support and love that you've given us over the last many months. Today I have with me Chirag Setalvad of HDFC AMC. Chirag, thank you so much for being with us on the Money Mindset.
It's my pleasure, Sonia.
It is one of the most popular asks to have you on the show because of the kind of performance that your funds have given in the last many years. So thank you for taking the time out. And one of the main asks was to understand what is your investment style, because I guess in today's day and age where the markets are at stratospheric levels, valuations are all over the place, it's a bit hard for investors to find value and to find good quality companies, especially from here on. So first, from your vantage point, where are we at in the market right now? And would you be slightly cautious at this level?
I think I would be more than slightly cautious. I think markets have rallied very sharply. You look at 5-year returns, they're in the 30s, both in the mid-cap and in the small-cap category. And valuations are now 30-40% premiums to their 10-year average. The 10-year average itself is at a premium to its longer-term average. So valuation from any metric standpoint look expensive. And we can see that in our own, we cover 450 companies at HDFC, and the number of buys versus sells has skewed towards sells versus buys clearly in the last couple of years, and especially in the last year or so. So it's becoming much harder to find value. Finding good quality companies is quite easy, right? Because good quality as represented by good managements and ROEs and so on, that is available. But it's just the price that we're paying. We are paying inflated prices to own these businesses. And I think that, as a result, warrants us to be very cautious. We've had a fantastic run for several years now. And even 10-year returns are elevated. If I'm not wrong, mid-cap, small-cap, 10-year returns will be 17-18%. And those are very strong returns. So we need to go through a period of consolidation. That might be a time correction, that might be a price correction. But there is no sign of it now, right? At every correction, we've seen a pullback, and we are back to all-time highs. So
absolutely,
I think one has to be a little bit careful. But again, in all of this, the key is, as I see it, to invest for the long term. So the two mistakes one can make: one is to buy obviously at expensive levels, and the other is to sell at low levels. Both of those get mitigated if you hold for an extended period of time. So I think the long term, helps a lot. But yes, we should be careful.
So when you say cautious, right, do you foresee a big fall? Because this is something the market has been talking about for almost 1 year now. It's never happened. The tariffs came and went, the wars came and went, the macroeconomic issues came and went, but the market climbed every wall of worry.
Yeah.
So A, why is that happening? And B, do you foresee any major price correction in this market?
If I had that answer, that's a trillion-dollar question. So I don't have an answer to that, right? How are you going to predict? Our ability to predict the market in the short term is very poor, right? Our ability to predict the market in the long term is very good. But everybody is concerned about the short-term view, and very few people are concerned about the long-term view. So you're right. I mean, we've passed by every massive event. I mean, who would have thought all of these events would have happened and the market would be an all-time high? There is an incredible amount of liquidity, right? The liquidity comes in from mutual funds. The liquidity comes in from insurance companies. Both of those are structural in nature of sorts. And there is a tremendous amount of liquidity coming in from the retail side. There is a lot of excitement. And hence, in the face of that liquidity, we have overcome all these fundamental and news flow challenges. But I think that cannot continue forever. So I think you have to be a little bit careful. But is it going to be a time correction? Is it going to be a price correction? It's very difficult to tell. I suspect it will be a combination of both. But we'll have to wait and see.
So how does one approach this market from a portfolio standpoint for the rest of 2025? What should the approach be? If you're a bit cautious, is it better to raise cash levels? Is it better to continue deploying? And also from an asset allocation point of view.
So we don't move into cash to a significant extent. Our cash levels vary from 0 to 10. So at 0, we are incredibly bullish. At 10, we are incredibly bearish. We are currently 6-7%, which reflects that we are cautious at this point of time. But we don't believe in having sort of 20-25% cash levels. And that's because every investor is different, right? So some investor wants to be 80% invested, some 100. And our job is to invest as best as we can in any market environment. And then it is up to the investor, based on his or her risk appetite, liquidity requirements, to be 70, 80, 100% invested. We don't make that decision for them. That decision has to be made at the investor level. We help that decision making by communicating to investors and communicating through distributors what our perspective on the market is. But then the investor obviously has to make their own individual decision. And cash is, as I said, 6-7% today. But our approach hasn't changed. Our approach is, always will be, whether it's a bull market or a bear market, is as simple as buy good quality companies at reasonable prices and hold them for an extended period of time. Now, that's every fund manager will give you this answer, right? There is no fund manager on earth who will tell you otherwise. But the trick is discipline, right? How disciplined are you to focus on the quality businesses, not get carried away by excessively cheap valuations, not to get carried away with management commentary and so on and so forth. So this is not about, we all know what to do. The key is to have the discipline to do that day in and day out and not get waylaid by things like cheap valuations or narratives and so on.
Okay. So I was going through some of your funds, right? You manage 3 funds, the small cap, the mid cap, and you also look at the children's fund.
Yeah.
So the mid cap fund, I think, has been one of the longest in terms of time that you've managed the fund. And I was going through some of the returns. I think over a 5-year period, 3-year period, the mid cap fund has given over 30% returns to investors. Tell me a little bit about your investment style in that fund. For somebody who wants to replicate that for himself or herself in their own stock picking journey, how do you invest?
Sure. So I think first, everybody has to follow their own individual style. I don't think anybody should try and replicate anybody else's style. Each person has their own strengths and weaknesses, and you've got to play to your strengths and avoid those weaknesses. What has worked well for us is to have a diversified approach, which is why we own 60-70 companies in our portfolio. We've held that number of companies when we were 1,300 crores. We hold those number of companies when we are 80,000 crores. We focus on building the portfolio on a bottom-up basis. So this is not a macro bottom-up, top-down approach. This is not a sectoral approach. And we focus, like I said, on good quality companies and hold them for an extended period of time and buy them at sensible prices. Now, what does each of those statements mean? We hold for the long term, and you can see that in our average, our portfolio turnover is 20%, or even less, 17%. So we're holding companies for 5-7 years. We want to have an ROE on aggregate which is higher than the benchmark and preferably higher than peers. So we typically have a 16-17% ROE.
Okay.
So we're owning good quality companies. We're holding them for the long term. And I think that has worked well. And we want to pay reasonable prices, which means we want PE multiples which are below average. So our fund targets to have a PE below average, an ROE above average, and a holding period which is 5-7 years. And if you do that and you buy into adversity, I think that's the other thing, that whenever times get tough, either for the market or for individual companies, we will typically add to our holdings, not subtract from them. And I think that gives us a little bit, that having that contrarian approach helps a little bit.
So good quality companies with a PE below average or ROE above average. Can you give me some examples just to understand?
I mean, you can see that in our portfolio. I mean, today is hard to get PEs below long-term averages,
Yes.
certainly. But you can see that in our portfolio. I don't want to get into stock specific names, but you see that across our portfolio.
So if you look at just your mid-cap fund, right, you are bullish on...
And sorry, I meant that on an aggregate basis, right?
Yeah.
So you have to look at from a portfolio, weighted average Ps, weighted average ROEs. So at a portfolio aggregate, you want to achieve that. So you'll have obviously some companies which are above average, some which are below average.
Correct.
But when you put it all together, that's what you try to achieve.
So two spaces that you're bullish on, at least that's what I gathered from your fund, is one is banks. You have a lot of PSU banks as well in your portfolio. And one is pharma and healthcare. So just take us through the rationale. First on banks, right? How are you positioned? Because PSU banks, of course, have had their peaks and troughs in the last many years. But right now, in terms of the entire banking industry and PSU banks particularly, what is the prognosis?
So, both of those banks and pharma is an outcome of stock-specific ideas. It's not necessarily that we like or don't like the sector. It's because we like individual companies. We populate the portfolio on a bottom-up basis, and those are outcomes from a sector standpoint. Having said that, broadly, we are still positive on financial services. We still think that credit growth of 13 to 15% is achievable. Asset quality remains benign, and valuations are still close to, if not below, long-term averages, right? And I think this has been called out by the industry and by many people for a long period of time. For a long period of time, that has not worked, and now it's working a little bit better. And that when in an environment where valuations in general for the sector are reasonable, it's a more fertile hunting ground to get individual ideas. That was true for pharma as well some time back. Now that has changed, right? Because pharma has done extremely well, and stocks are now expensive.
Yeah.
So our view on pharma is changing, but our view on individual stocks may or may not change because we still like the individual thesis of that particular company. I think it's always important to keep in mind in sectors that we like, there'll be plenty of companies that we don't like, and vice versa. So it's not necessarily that we love pharma, but the individual companies that we like. It's not necessarily like that we like IT, but the individual companies, again, where we like the story.
Okay.
So it's very, very stock specific.
So when you say you have a bottom-up approach, right, and this is something I think you've always done for the longest time in your career, where you've done bottom-up stock picking. When you say you pick a good quality company, what are the what's the checklist like? Apart from valuations, keeping valuations aside, what's the checklist in a good quality company?
Ideally, you'd like companies which are reasonably easy to understand. So you don't want to, you want to have some degree, I wouldn't say simplicity, but at least where we are able to understand the business. That allows us to also buy during adversity, right? Because the less complex a business and the greater our understanding, the easier it is to buy during tough times.
Can you give me an example, just for understanding?
I mean, there are plenty.
It doesn't have to be in your portfolio
Auto
now.
component companies as an example. Good diversified businesses.
All the?
Auto component.
Auto component, okay.
Diversified between aftermarket and OEM, diversified between domestic and export, diversified between four-wheelers, two-wheelers, and so on. Right?
Okay.
So that's one example of and reasonably straightforward business to understand. You want companies with strong ROEs, right? So typically, ideally you'd want 16, 17% plus. You want companies which are growing reasonably, 14, 15% plus growth companies. And of course, I'm keeping the valuation bit aside. And you want businesses where history has demonstrated the quality of the business. So it's not that so far you've been an average business, but going forward, you're going to be a fantastic business, right? Because the future is always bright and orange or predicted to be bright and orange. But it's important to look at the past. How have ROEs been? How have cash flows been? Ideally, you'd want companies with low working capital, right? Because that helps in your free cash flow generation. You want capital intensity to be lower. So reasonable free cash flows, reasonable ROEs, decent growth, and management which can execute. I've more and more over the years realized the importance of having high quality management. And every year that gets reasserted. When you see the businesses that we own which have done well, companies like Gabriel, etc., high quality management, and the ability to execute on that growth and manage adversity, really pays off over the long term.
Okay. So you want to give me, of course you don't want to talk specific stocks, but just, because it's easier to understand for a viewer, right? Say any bank that you've taken, whether it is Bank of Baroda, which is in one of your portfolios, whether it is Federal Bank. I'm just trying to understand from all these checks and parameters that you've put in place. some of these companies, despite having good managements, decent managements, don't perform for the longest time, right? For example, PSU banks, I think there was a phase when they didn't perform for 10 years.
Yeah.
What do you do when everything fits in your criteria, but there is non-performance?
Just hold on, right?
There's an opportunity cost.
There's always good, and that's bound to be, right? You can't have 100% of your portfolio firing all the time, right? You'd be the number one performing manager at all times. That cannot happen. So I think you have to have that patience, right? PSUs, we've had a love affair, hate affair, love affair, hate affair, love affair, in the last 10 years. So ideally, in the hate affair part of the market, you want to add to them, and in the love affair, you want to reduce them. The same thing with pharma, right? It's not that pharma has always been a loved sector. Pharma has been loved, pharma has been hated.
Yeah.
So when it's hated and valuations are in your favor, that's when you want to add to them.
But how do you when is it that you start losing patience? If a stock has not performed for, say, 4 quarters, neither have earnings performed 4, 5, 6 quarters. At what point? I'm just trying to understand.
I have a lot of patience. I think 4, 5, 6 quarters is nothing. That's, we're saying quarters. We're talking in years. We're supposed to be 10-year, 15-year investors. What is 4 quarters? That's 1 year. That's nothing. A stock doesn't perform for 1 year. We will go and visit the company. We'll meet them. We'll make sure nothing's going wrong in the industry and at the company level on a structural basis. But if nothing has changed, we'll hold on, we'll add, and we'll keep adding, and we'll take it to as much as we can and just wait. There are so many companies extremely patient, and sometimes that patience will pay off and sometimes it won't, but you still have to be extremely, extremely patient. I think you have to revisit your investment case and see, is your assumption or are your assumptions on that company wrong in some way, and you keep sort of I think checking on that, but otherwise you should be extremely, extremely patient. So we have a very long-term perspective in that sense. But I'll also add, not all our investments are 10-year investments and 15-year investments. So, those are the sort of marriages in our portfolio. We do have shorter-term investments in the portfolio as well. I mean, for us, short-term is 1-2 years, where we feel that there is going to be a meaningful change in the business over that period of time. We don't necessarily believe it's a great 10-year investment, but we do think we can make money over a shorter period of time. So there is that element, but hopefully 80% of the portfolio is long-term and 20% is short-term, with our definition of short-term being a couple of years and long-term being, much more than that.
So also, when do you decide when to sell a stock? Because that is also something that people struggle with, right? You identify a good stock, then it doesn't perform for years. Suddenly it's off to the races.
Yeah.
And when do you decide, okay, now I should book out?
So I think we sell under 3-4 circumstances. One is when we have more than achieved our fair value, right? So if our fair value is 100, we don't want to sell at 100. It's a high quality business. It's difficult to get in and get out of. So if it gets to 30, 40, 50% overvalued, so you start at probably 20, 30, and then you accelerate as that valuation becomes more and more expensive.
20, 30 what? Sorry.
If you think that the business is worth 100, and if it becomes 20, 30% more expensive than that, so if it goes to 120 or
But how do you decide how much it's worth?
You look at long-term valuation metrics, whether it is PE multiples or EV EBITDA or price to book or what have you. Yeah. So you have a certain price target. And once you've exceeded that price target, that's when you start looking at the exit, right? But you don't want to get out immediately. These are good quality businesses. So you want that excess to build up a little bit. So once you get to a meaningful excess, then you want to start selling. So I think one is from a valuation standpoint. The second is nothing else changes, but you get a better idea somewhere else. So your thesis remains the same, but you get something which is better and you don't have cash in the portfolio, then you switch from one idea to another. The third, which is probably the hardest, is when your thesis goes wrong, right? So there's a great saying that when things go wrong or when the ship begins to sink, you jump, don't pray, right? So you don't hope and pray that things will improve. And I've done this so many times. No, it'll improve, it'll get better, it'll get better, it'll get better. And it doesn't. And eventually you sell at much more of a loss than you would have anticipated. Now, you don't want to sell at the first sign of trouble. So it's a little bit tricky. But if you feel it is something which is, the problems are sustainable, then you want to get out. So if our thesis goes wrong, so I think those are the three circumstances. One is things go well and valuations become very expensive. Two is if you get a better opportunity elsewhere. And third, of course, is if your idea goes wrong.
So suppose you have an idea, right? It can be any stock. There's suddenly, after many years, there's a complete disruption in the market. Whether it is an entrant of a larger player, whether it is lots of competition coming in, whether it is change in regulations. Do you wait it out or do you decide then and there? Like for example, in the paints industry, now everyone's talking about it with the
Yeah.
entrance of newer players, larger players, right? What do you do with these stocks which have been great legacy businesses, but now suddenly the market is disrupted? Do you wait and watch?
So the paints as an example, we are waiting and watching, right? Because, and so we have been for some time. And I don't think the valuations have come off enough, right? A lot of these companies are still extremely expensive and you've not seen meaningful growth in these companies. So they still have legacy valuations, but the growth profile has changed quite a bit. Of course, with real estate picking up, the growth profile can improve and so on. But we don't own paint companies to a meaningful extent. And so we are waiting and watching. So if there is a disruption, then we'll try and assess the extent of the disruption, how much of it is captured in the price. If it is not captured enough, then we'll wait on the sidelines for it to be captured. And if it doesn't get captured, we'll sort of avoid it entirely. In paints, there has been obviously some comparative disruption which has taken place. There's also been an overall slowdown. And hence we're waiting. But we'd like to see better prices. I don't think we're at a point where these are great fantastic legacy businesses, but they're not at prices which are juicy enough.
Okay, fair enough. So coming back to when to sell a stock, right? You said you gave us 2-3 reasons when you decide that, okay, now we should sell a stock. Can you give us any examples of when you perhaps sold a stock at X and then you regretted it because it went to sort of 2X, 3X from there?
Oh, there are plenty, right? How often are you going to time the top, right? So, we saw that in some of the hospital stocks where we sold them and they continue to do extremely well. But it's fine. We don't have that feeling of having missed out. They did very well for us and they did even better after that. There are a number of these FMCG stocks. But this is a business. It's not only about identifying the big winners. That's what we focus on. It's as much about avoiding the big losers.
Yeah.
And if you do that, I think you should do reasonably well.
I think I heard you say this in one of the interviews that I was watching of yours, where I think a big part of your equity journey is mitigating losses or reducing losses, right? Making sure you don't have major losses. Tell us a little bit about that. Like as a young investor, how should they approach building their portfolio? At what point does preventing a loss or mitigating a loss become important in your portfolio?
I think especially younger retail investors tend to be very, very overconfident, tend to take sort of outsized risk. And I think the key is to balance that a little bit. And mitigating losses is very important. And I was told very early in my career that risk, people look at risk in various ways. But the best way of looking at risk is to understand the company that you own as best as you can, right? Because that's fundamental risk, the risk of the business. So I think my advice would be, this is a highly competitive business. You have, dozens, if not hundreds of analysts and fund managers tracking and following companies. So to read as much as you can on that company, right? You read the annual reports, you follow all the transcripts, you meet management as often as you can. If you can do plant visits and so on, all of that, you just do as much effort and work that you can in that company. And that by doing that, you get a good understanding and that reduces your risk. And then you do have the valuation risk, which you try and mitigate. So try and get your entry point right. And if things go wrong, fundamentally, even if you've lost 15-20%, it's better to get out than having obviously lost much more than that. And good quality businesses tend to continuously surprise positively. And the value traps can become sort of very painful over a period of time.
So talking about some of the funds that you manage, right? And this is some criticism that, of course, I'm sure you get yourself as well. Say the small cap fund. If you look at the sector average over the last, say, 10 years, and if you look at the HDFC small cap fund performance, it has underperformed the benchmark. What would your argument be to that? And because one would assume that such a large fund house would at some point, such an active fund manager would at some point outperform the benchmark, but that hasn't happened. So what would your argument be to that?
So actually over 3, 5, 10-year periods, we've outperformed the benchmark. So where we've not always outperformed is versus peers. There are those who are ahead of us, and of course we're somewhere in, I would say, in the middle of the pack. But we've done, I think, a reasonable job versus the benchmark. And you're going to have periods of underperformance and outperformance. And, in the last 6-9 months, year, we've picked up performance once again. So I think what has happened is that in a market which does extremely well, and we've always called this out, that in a raging bull market, we will tend to underperform because we don't own the high-risk businesses, the poor quality managements, the narrative stories, which tend to participate in those kind of markets. In a bull market. And that's the kind of market we've been in the last 3-4 years. And that's why there's been a degree of underperformance. But we have, still done reasonably well. It's, I think, versus benchmark, we are still sort of 3-4% ahead of the benchmark. And versus peers, we've caught up quite a bit. So I think we've done a decent job. So if you look at performance more recently, it's picked up, and not only over the last sort of 1 year, but even over the last 3 years, 5 years, it's picked up quite well.
Okay. So in a bull market is where we all underperform, but
we've
in a bear market, it's resilience.
Yeah. So of the 3 market environments, in a bear market, we'll typically do very well. In a bull market, we'll tend to underperform. And in a market which is behaving reasonably, which is sort of 10-15% up and down, we should outperform 60% of the time. So when you put all of that together, our long-term performance comes in quite strong.
Okay. Coming back to selecting a stock, right? Value versus growth. What is the strategy that you generally employ, and can you take us through that a little bit?
First of all, the value versus growth definitions themselves change over a period of time, right? Sectors which are value then become growth, and those which are growth become value. So I think we have to be careful about bracketing people into value and bracketing people into growth. I think that's one part. But yes, the market does rotate, right? The market rotates between market caps, large cap, small cap, mid cap. That rotates. The market rotates between sectors. Different sectors do well at different points. The market rotates from a style perspective. Growth does better, value does better.
But what has your favorite style been to invest?
We are very stock specific. We are happy to own growth businesses, value businesses. We are somewhere in the mid. See, most investors, and we are certainly one of those, we are growth at a reasonable price. We are not going to buy fantastic businesses at obscene prices. We are not that kind of investor. And that works for a lot of people. So I think the key in this, and I'll answer that, but I think key in this is not to disparage the other person's style. So the value guys look at the growth style and say, you guys have no concept of valuation. And the growth styles look at the value guys, and you guys are just stuck at valuations, and that's all that matters to you. And I don't think that's true. You've got to work to your strength. If you're a value guy, do value. If you're a growth guy, do growth. And don't disparage the other person's style. It's different strokes for different folks. What works for you is what you should do. I think the dangerous thing is value guys trying to be growth guys and growth guys trying to be value guys, and then switching depending on what you think will work in the market, right? So you stick to your style. Sometimes it will work, sometimes it won't. That's fine. But at least you're true to your style. And we are somewhere in the middle. We are growth at a reasonable price. We don't want to own either of the extremes. The cheap stuff, which we don't think is of good quality, and a lot of the other value stuff, we tend to avoid the bottom end, and we tend to also avoid the top end. And therefore, we are somewhere in the middle. And I think most investors occupy that space. There are few at the value end and few at the growth end. But most of us tend to be in the middle area.
So since you have growth at a reasonable price, that's your main philosophy. Over the next few years, right? I know you don't look at theme sectors, you believe in more bottom up. But still, if you were to identify a few themes for us, where companies are growing fast, the valuation is not that astronomical, and there is a huge moat in terms of, say, opportunity in India, or just like a top-down approach, if you had to give us a couple of themes.
I don't see any theme which really stands out as being, this is a market which is extremely well discovered. Where is this undiscovered theme? What are we talking about, right? I mean, you can identify micro themes, one can argue, but larger, meaningful themes where there is reasonable market cap and reasonable number of companies in a bull market like where we are today, they don't exist, right? I mean, if there was an undiscovered theme which is doing well at sensible prices, we'd all be clamoring for it.
So how does one make money then in this market?
It's going to be tough. See, we are a relative return investor.
This is not an absolute return business.
So if the market falls by 25% and we've fallen by 17-18%, we've done a fantastic job. So we're not here to give absolute returns. So you can always find relative value. Relative value is always available, 365 days of the year, 10 years in the decade, right? Because it's compared to something else. But absolute value today, very hard to find.
Wow. In your own personal journey, I mean, you've been doing this for what now, 30 years?
25 years.
25 years, long time.
It's been a long time.
Has it been as rewarding as it looks?
No, it's a fantastic business, right? Because you get to first of all put your convictions to play and see that play out over a period of time. You get to meet incredibly smart people. You get to meet managements. You get to meet analysts. So it's a fantastic business, right? And you of course get to make returns for investors, and the benefit that they accrue from that is also very rewarding. So from all perspectives, you get to read so much. You read about diverse industries. There's so much knowledge out there to gain from. So it's a fantastic business. I think the part which is challenging is that you get assessed on a daily basis, right? So daily, weekly, and so on. So that stress can build up when underperformance is for an extended period of time. So then you have to fall back on your convictions and say, listen, I'm doing what I think is best, and I'm sure that will work out over a period of time. So the key is not to shift to what is working at that point of time. Otherwise, you're always chasing a trend. So you got to stick with what you believe in.
And when you started off, how did your journey begin? I mean, how did you get into this industry? You've always been with HDFC, right?
I've been, well, for most of my career. I joined HDFC at its inception in 2000. I joined as an analyst, and I was completely clueless about the markets. I was very fortunate to be given an opportunity here by the CIO at that point, Sanjay Bhattacharya. So he reposed a lot of faith in me. He handed me a fund quite early in my career, and he taught me a lot in terms of how to look at companies and fundamental and risk analysis and so on. And then over a period of time, the funds grew. I was given more responsibility, and then over the last couple of years, I've been responsible as head of equity. So it's been an interesting journey. But when I joined HDFC, there was a bunch of Fevicol boxes and furniture lying around, and it was, we had no money, zero assets under management, and today we are fairly large. So it's been an interesting journey.
Your own personal journey would have also been like phenomenal, I'm assuming.
I've been very fortunate, genuinely, to have worked with incredible people. I've learned a lot from Prashant. I've learned a lot from Sanjoy. Prashant is an incredible manager with a great work ethic. I've learned a lot from him. And, I think a lot of attention is on us, right? Nobody interviews the team, right? We've got a team of, 12 analysts. They're the backbone of this organization, right? You don't have, it's always one-on-one, right? Yeah. You're interviewing me. You don't interview the 12 guys who, without them, we'd be nobody, right? So we take a lot of the credit and discredit and the limelight, certainly. But they are the strength, and they're incredibly smart, driven analysts. And I think it's on their suggestions and recommendations that we do well. So I'm very fortunate to be in a company with a strong brand, which allows us to attract that talent. So I think, I'm grateful to HDFC and grateful to all my colleagues. I genuinely have learned a lot. Sanjay was a fantastic investor. Prashant was a fantastic, and both of them are still fantastic investors. And so imagine if you work with such incredibly smart people, how could you not possibly learn? Something has to rub off, right?
Yeah, of course. It's like a lifelong MBA program that you have.
Absolutely.
So, this show is called Money Mindset. It's largely to understand how successful money managers, not just money managers, but successful leaders conduct their life and their journey, right? So I want to ask you, because a lot of our viewers are young 20-year-olds, 25-year-olds, just starting their journey. Now, we kind of live in a bubble, right? But a larger part of India has barely maybe 2,000, 3,000 rupees to invest into the market. And if you look at, average, the per capita GDP, etc., we are really just 0.1% of the population.
Yeah.
So for that average salary goer who has a little bit of money to invest, what is your advice? How does one really start building wealth from ground zero?
So I think that 2 or 3 pillars, right? Everybody knows it, and but certainly not everybody follows it. Number 1 is asset allocation, right? That is going to determine all your returns. People are so focused and obsessed with picking the right mutual fund or picking the right stock, and the key is asset allocation, right? So if you're young, you should have most of your money in equities. If you're old, you should have very little money in equities. And I think it's imperative to start as early as possible, right? So I think that's point number 1. I think the second is really hold for the long term. I think we've totally got this wrong. Our idea of long term is 1 year, 2 years, 3 years, 4. The minute you say 10 years, people roll their eyes. Why are people rolling their eyes at 10-year holdings? Every serious investor, every investor who's made serious money has held for the long term. And for them, it's not, some of them have held it for like Obviously Buffett says it's forever and so on, but at least hold it. You should be holding stocks for 10 years, 15 years if you can. So I think the long term takes care of almost all mistakes. The two mistakes we mentioned earlier, right? Selling at the wrong time, buying at the wrong time. So I think that's the second part. And the third is to be contrarian, right? Investment times are really tough, and lighten up a little bit when times are fantastic. So, how many people invested meaningful money at the bottom of COVID, at the bottom of the financial crisis, right? It's not easy because there's so much uncertainty. And how many people put serious money at the top of markets because everybody's making money. So I think if you follow these 2-3 principles, get your asset allocation right, focus on the long term, be contrarian. This is actually a very easy business, which we have overcomplicated because of our behavioral biases, right? Because of our inherent greed and so on.
So holding for the long term is something that, of course, everybody teaches you in the last 10, 15 years. But some people now believe that that doesn't hold true anymore because of how fast the world is changing, how much disruption there is, whether it's with AI, whether it's with, so much disruption in different industries, right? So does holding for the long term, buy and forget, does that style of investing still hold?
So I think, that's where I think it certainly holds. So that's the quick answer. But it's not buy and forget, right? You have to buy and revisit and revisit and revisit, but you don't have itchy fingers, right? The minute something goes slightly wrong, we don't run for the exits. If you feel something is going to go structurally, meaningfully, and sustainably wrong, of course you get out, right? But we are so itchy, the minute things go wrong, imagine in the journey of all the multi-baggers which have taken place. Did they not have meaningful periods of underperformance? And imagine if you sold every time, how would you get back into those businesses, right? So I think it's key to hold for the long term. I don't think that has changed. I am old-fashioned. I still believe the more things change, the more they remain the same. Of course, AI is happening, and a lot of these things do take place, and they affect individual companies and certain sectors. And you keep revisiting and evaluating, but at the first sign of trouble, you don't get out of them, right? In fact, what's happened to the belief of being contrarian? That at the first sign of trouble, or not, when trouble hits, you actually add to your holdings, not reduce them. So I think long-term investing I don't think that has changed at all.
But if you look at stocks like, say, HUL, ITC, HDFC Bank, these stocks, if you map a 10-year journey, maybe not HDFC Bank as much, but if you map a 10-year journey of some of these companies, they have really not given you, they've given you suboptimal returns, to be honest. Great companies, super businesses, but if you've held them for a long period of time, the returns are not great. So there's an opportunity cost loss there.
Sure.
So this buy and hold strategy.
So you don't buy and hold always and forever, right? So there's a point of time when either the companies become very expensive, or the growth slows down, or the competitive intensity increases and so on. And then fine. Then you don't hold for that 10, 15-year period. But, 90% of investors in HDFC Bank are delighted, right? Now, HDFC Bank did go through a period of time when it didn't perform.
A long period of time.
Right. And at that point of time, it went from 0 market share to 16% market share, and there was, a number of issues around that and so on. So yes, it doesn't mean that every stock has to be held forever, but a large portion of your portfolio should certainly be held for a long period of time. But when you feel that structural challenges or challenges which are, if something is going to be a challenge for a year, that's fine. 2 years, that's fine. But if something you feel is going to be a challenge for a little bit longer, then you take a step back. You can get out of that business and then get back in at a later point of time. But I don't think that fundamental tenet of investing for the long term, I don't think that has changed at all.
Okay. So coming back to the advice for a young investor, you said the asset allocation, holding for a long term, or being a long term investor, and contrarian investing, right? These are the 3 pillars of investing. Anything else that you'd want to?
And I think people have to work hard. I think, everybody, we are doing this day in, day out, 9 hours a day or 10 hours a day. I think people have to read a lot about their companies, right? I think there is a lot, not a lot, but I think people do analysis, but I think you have to really dig deep, right? I think you have to put a lot of work and effort into understanding your companies. And if you do all of that, if you're contrarian, if you're long term, you'll do fine. And individuals have the advantage of having small portfolios, so they can have concentrated positions and so on, which can work well.
Okay, great. But of course, for people who don't have the time and energy, or the time rather to do that, and they have other jobs, and it's better to just go through the active fund management or passive fund route, right?
Yeah. So, I think it's time, energy, and it's also inclination. I think there's certain personalities are well suited to investing, right? Those who are inherently patient, those who are inherently work against the grain. I think that personality also helps. Those who are more aggressive and risk takers, I'm not sure can work for a period of time, but that can work against you over an extended time frame. But for most investors, you don't get the time to analyze companies and sectors and so on. And it's best to put it into a mutual fund.